Welcome back to The Explainer. Today, we are tearing into one of the most fascinating financial events of the year. On the surface, we're looking at Dell Technologies and their absolutely explosive Q1 fiscal 2027 earnings. But I promise you, right beneath those flashy headlines, there is a hidden daily repricing war happening across the global AI supply chain. We're going to really focus in on how this single earnings report completely shocked the market, sent the stock price soaring, and, most importantly, how the insane surge in AI demand is literally forcing the tech industry to rewrite how they price hardware. Okay, let's dive right into this. Here's our roadmap for today. First, the earnings bombshell itself. Second, how AI servers ignited this growth. Third, the massive supply chain squeeze. Fourth, how this is reshaping pricing mechanisms. And finally, Wall Street's completely new valuation of the company. We're going way beyond the numbers to understand the fundamental mechanics operating beneath the surface. Starting with Section 1, the earnings bombshell. When Dell dropped these Q1 numbers, Wall Street's reaction was, well, pure shock. The market expected a good quarter, sure, but Dell absolutely obliterated those expectations. 88%. Let that sink in for a second. Dell saw an 88% year-over-year revenue surge, pulling in a staggering $43.8 billion for a single quarter. For a legacy hardware company that's been around for decades, nearly doubling your revenue in 1 year, that's almost unheard of. It's actually their fastest growth on record since returning to the public market. And the market reacted aggressively. After hours, Dell's stock price rocketed up over 30%. This wasn't just a bump. This was a violent, massive revaluation event. Investors suddenly woke up and realized that the old financial models they were using to value this company completely obsolete. The sheer scale of these numbers is wild. The $43.8 billion in revenue is great, but look at the diluted earnings per share, $5.24. That is a 282% spike. This proves a really crucial point. Dell isn't just pushing more metal boxes out the door. They are turning that massive top-line growth into hyper-efficient, massive profit. Add in $4.1 billion in operating cash flow, and you're looking at an absolute financial juggernaut. Which brings us to Section 2. What exactly ignited this historic performance? The answer points directly to AI infrastructure. And this brilliantly illustrates the catalyst. Last year in Q1, Dell's AI-optimized server revenue was about $1.88 billion. Fast forward to this quarter, that number exploded to $16.1 billion. That is a 757% year-over-year explosion. It's just an absurd leap. To really wrap our heads around why Dell is winning so big here, think about the classic shovel seller metaphor. In this AI gold rush, everyone knows NVIDIA, right? They make the GPUs, the core chips. NVIDIA builds the engine, but Dell builds the entire car around that engine. Enterprises can't just buy a raw chip. They need the chassis, the advanced liquid cooling, the memory orchestration, the actual enterprise deployment. Dell is the physical vehicle bringing AI into real corporate environments. And the appetite for those vehicles is absolutely bottomless. Right now, Dell is sitting on a staggering $51.3 billion AI server order backlog. To put that into perspective, if Dell stopped taking new orders today, literally right now, their factories would still be running at 100% maximum capacity for over half a year just to clear what's already on the books. It's a great problem to have, for sure. But it begs the question, what actually happens when the demand for AI infrastructure so drastically outstrips the physical hardware supply? This is where we hit the hidden deep current of this whole situation. Section 3, the supply chain squeeze. This was arguably the most fascinating and critical revelation from the entire earnings call, and it changes how we look at IT hardware entirely. Pay close attention to this admission from Dell COO Jeff Clarke. Because upstream component costs are spiking so violently, Dell has had to completely abandon the IT industry's standard practice of stable monthly or quarterly pricing contracts. Instead, they've been forced to become a scarce resource supplier, literally quoting prices daily. That is a fundamental upheaval of the traditional B2B business model. So the crucial point is understanding what's causing this bottleneck. It's not just about getting enough NVIDIA GPUs. This squeeze is hitting DRAM memory, NAND storage, standard traditional CPUs, and liquid cooling systems. Like management bluntly stated, demand is not their problem, supply is. If they had the parts, these record-breaking numbers would be even higher. To quantify how severe this upstream pressure is, UBS reported that PC and server makers faced up to 110% higher memory prices just in the first quarter. The hardware market is basically gripped by pure panic buying, with companies fighting tooth and nail for supply to feed the massive configurations required by AI GPUs. Moving to Section 4, these shortages are fundamentally reshaping pricing mechanisms and how this entire industry does business. Let's walk through the logic chain here. As the industry shifts toward agentic AI, where AI isn't just a chatbot, but an active agent doing background tasks, it creates massive new workloads for traditional CPUs, not just GPUs. So, component demand skyrockets across the board. That causes upstream costs to surge, which forces Dell to enact that daily repricing mechanism we talked about. They aren't raising prices for fun. The cost of raw materials is literally shifting beneath their feet every 24 hours. Now, what's really interesting about this breakdown is that anomaly right in the middle, traditional servers, jumped 92%. This completely debunks the idea that AI is cannibalizing Dell's legacy business. Instead, AI is lifting their entire infrastructure ecosystem. All those AI agents need traditional compute power to orchestrate and manage their massive workloads. Finally, Section 5, Wall Street's new valuation. Because of this totally new dynamic, the financial world is entirely redefining Dell's identity. The market used to treat Dell like old Dell, a slow-moving legacy PC and hardware maker. Short sellers who traded on that outdated logic got absolutely blown up recently. What this earnings report cemented is new Dell, a foundational, indispensable AI infrastructure powerhouse that controls the physical, nuts and bolts deployment of the AI revolution. That is why the stock price went ballistic. And objectively speaking, we've seen massive institutional momentum backing up this new identity. Look at the timeline. Earlier disclosures showed former President Donald Trump taking a large position in Dell, followed by public endorsements. Shortly after, the Department of Defense awarded Dell a massive 5-year, $9.7 billion contract. All of this high-profile backing culminated right alongside these blockbuster earnings, completely cementing market confidence. Let's see how this builds into the future. Management aggressively threw out their old forecasts and revised their FY27 guidance way up. They're now projecting total revenue between $165 and $169 billion, expecting AI servers alone to bring in roughly $60 billion of that. They're targeting a non-GAAP EPS of $17.90, filtering out one-time costs to show their true operating muscle. By hiking this guidance, Dell locked in this new valuation narrative for good. So, as the physical infrastructure of AI grows more expensive and far more scarce by the day, it leaves us with this provocative question. Who truly controls the future of the tech industry? Is it the companies writing the code or the ones holding the keys to the physical hardware factories? It's a massive shift in power. Thanks for joining me on The Explainer today. Keep questioning the numbers, and I'll catch you next time.